If you're a dental practice owner, you probably look at your production report every single day. You know your daily production, you may know your collections, you know how many patients came in, but here's the problem. I've seen practices producing $1.5 million a year and still struggle with profits because production does not equal profitability. And today, I'm going to explain why production report, no matter how detailed, will never replace your financial statements. The problem: production reports are operational tools. They tell you what was billed, what procedures were completed, what each provider produced, daily, weekly, monthly totals. But production reports do not tell you what your true overhead is, whether your employee expenses are too high, if your supply costs are creeping up, what your actual EBITDA is, and whether you're keeping enough of what you produce. Many dentists assume, if production is strong, I must be doing well. This assumption is dangerous because I've seen practices with strong production and weak financial performance, and the owner didn't know until months later. If you haven't met, my name is Bhola, and we specialize in bookkeeping and financial reporting specifically for dental practice owners. We help dentists get clean, updated monthly financials so ownership can make better decisions with confidence. On this channel, we focus on clear numbers, better decisions, and higher profits for dental practices. And today, we're talking about why being busy doesn't automatically mean being profitable. Let's simplify this with an example. Let's say your practice produces $1.5 million per year. For simplicity, we're going to assume that 100% of your production is collected, and therefore your total collections are also $1.5 million. That sounds pretty healthy. But now, let's look at the financial side. Based on strong single practice benchmarks, here is what percentages typically look like. Now, let's apply that to $1.5 million in revenue. If things are healthy, EBITDA should be roughly 35.22% of $1.5 million, so about $528,000. That is strong. But here's what production reports don't show. What if employee expenses are not 31%? What if they are 36%? That 5% difference is about $75,000. That's $75,000 gone. Your production report will not show you that. Only your financial statements will. Let me give you a real world style scenario. Practice A produces $125,000 per month. Owner checks provider production, hygiene production, case acceptance, and adjustments. Everything looks solid, but when we prepare monthly financial statements, we see employee expenses are at 34%. This is a little bit more than the dental average of 31%. Dental supplies at 7%, again a little bit higher than the benchmark of 5.58%. And lab at 7%, again above the dental average of 5.86%. That difference doesn't look dramatic on paper, but let's calculate it. Employee difference, 3% of $1.5 million, about $45,000. Dental supplies difference, 1.42% of $1.5 million, about $21,000. Lab difference, 1.41% of $1.5 million, around $17,000. That's over $83,000 in reduced profitability. Production report still says $1.5 million. Owner feels busy, schedules look full, but profit is leaking quietly in the background. This is why production data cannot replace financial reporting. They measure different things. Production measures activity, financial statements measure performance and profits. Why this gets worse in group practices. If you own multiple locations, this becomes even more critical. Average EBITDA for group practices is around 17%. That's significantly lower than a well-run single practice. Why? Because production reports don't consolidate overhead properly across locations. You might see location A produced $900,000, location B produced $800,000, but you do not see combined payroll inefficiencies, duplicate administrative costs, facility cost imbalances, supply pricing inconsistencies. Without consolidated financial reporting, You don't know if one location is subsidizing another. Your overhead structure is bloated. Your group profitability is drifting downwards. Production reports cannot give you that combined clarity. Here's the core difference. Production reports tell you what you did. Financial statements tell you what you kept. Production reports answer, how busy were you? Financial statements answer, did that business translate into profits? And profit is what allows you to reinvest, hire better, expand, reduce stress, and increase personal income. Here is what I will take away from this video. Production reports are operational tools. Financial statements are strategic tools. You need both. But if you're only reviewing production and not reviewing monthly income statements, expense percentages, EBITDA percentage, benchmark comparisons, then you are making decisions without full visibility. And clarity is what drives better decisions. When you know employee expenses are at 31% instead of 35%, dental supplies are at 5.58% instead of 7%, lab is under control, EBITDA is trending upwards. You are no longer guessing, you are managing. That's the difference between feeling busy and being profitable. If you're currently relying mostly on production reports to understand your practice performance, it may be time to look deeper at your financial structure, because strong production is good, but strong profitability is even better. Thank you for watching.